sort of offend basic fairness to say people have contributed to a system under one set of rules with one set of expectations and made long-term plans based on that, and then we're changing it. So suddenly you thought you were going to get 250,000 of tax-free cash. Now you're only getting 100. Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm here with my Fidelity colleague, Marianna Hunt. And we're going to be talking today about tax-free cash on pensions. This is the part of your pension savings you can take currently from age 55, but that will change to 57 in 2028. And it is completely tax-free. It is a very popular part of the pension system, so there is a lot of concern that tax-free cash could be a target of the government when the budget comes around on November 26. We'll discuss today whether you need to be worried, and we'll give you the best and worst reasons to take your tax-free cash now. Before we get into it, let me remind you that if you find this video useful or interesting, to please subscribe to the channel. Give us a like, join the discussion in the comments if you'd like to do that. It really does help other people find what we're doing here, and it means that you're going to get new content as it is released. Now, that said, Marianna, welcome along. How are you?
I'm good. How are you doing, Ed?
I'm very well, Marianna. Tax-free cash. Let's start with a recap of the rules as they are. Everyone's going to know this as tax-free cash on pensions, but this is tax, this is pensions, so we have to have a confusing technical name for it as well. What is that technical name, and how does this whole thing work?
So you might also hear tax-free cash referred to as PCLS, which stands for Pension Commencement Lump Sum. It's basically the same thing, but there's just a more jargony way of saying it. And we don't like jargon on this podcast. So personally, I'm going to stick with tax-free cash. Yep. I also think PCLS sounds a bit like an 80s synth band. So let's not go down that rabbit hole. But what is it? So when you come to accessing your pensions, there are various options on the table. And one of those options is usually that you can take up to 25% of your pension tax-free as a lump sum, as you've said. Now, this should be available whether you've got a defined contribution pension, which is the kind of pension that most of us have today, or a defined benefit pension, which is the older style of pension, which pays you a guaranteed income based on your salary.
Still going in the public sector, other places.
Exactly, yeah. But it will be calculated slightly differently for those defined benefit pensions. So there is a cap on how much tax-free cash you can take. Now, you've said up to 25%, but that is up to a maximum of around £268,000. This has been higher in the past. It's come down. So we have seen that before. And as you've mentioned, it's possible it could come down further. Now, what's worth mentioning is there are some old pension plans which have protected tax-free cash or enhanced tax-free cash. And it's really worth checking whether you have one of these, because I've heard some financial advisors saying they've seen policies where people can get up to 85% of their pension as tax-free cash. So that could be really valuable if you've got that.
Yeah, it's obviously, as I said in my intro, a very popular part of the pension system. It's available from an age when actually lots of people will still have many years of work ahead of them, and they can get at that money, and as a big lump sum. So, you know, it's why maybe you see lots of 50-year-olds or 50-somethings with new cars or new kitchens or whatever. They suddenly have access to this money, which they have been saving, of course, for many, many years.
Although, just to quickly jump in on that, I think if you are taking it in your kind of 50s, it's really important just to make sure that you're not accidentally triggering the money purchase annual allowance. So if you are just taking your tax-free cash, then you should be fine. But if you take your tax-free cash and any taxable income, then you could trigger this thing called the money purchase annual allowance, which means essentially that you could end up only being able to put up to £10,000 per year into your pension from that point. And if you're in your 50s and 60s, you're probably kind of in peak earnings. And so really, you're probably wanting to put as much as you can into your pension.
Indeed.
So if you take your tax-free cash and accidentally trigger this at the same time, then that could be really damaging.
Indeed. And this tax-free cash element, this 25% tax-free cash, for many people, this is actually what makes pensions advantageous from a tax point of view. You'll often hear people say pensions are the most tax efficient way to save money. And I don't want to go over every rule of pensions, but they're basically tax efficient in three ways. Any gains you make in terms of investment gains in a pension are tax free. That's like an ISA. And so that's obviously very worth having. You also get tax relief on your contributions, which means they have income tax relief on the way in. But what's less, well understood and less commented upon is that you have tax on the way out. Now, the way that works is if you contribute at a higher rate and then withdraw at a lower rate, it can really work in your favour. And lots of people will plan to do that. But if you're not doing that, actually that just nets out. And so, a basic rate taxpayer who contributes at a basic rate and then withdraws at a basic rate isn't actually getting that tax relief advantage. It's this 25% tax-free cash that is actually the thing that makes pensions advantageous.
Yeah, it definitely tilts the balance. It's that perfect trifecta of tax relief options there with pensions.
Yeah, exactly. So taking all of that together, it would be very worrying, would it not, were the government to reduce tax-free cash on pensions. So are they planning any such changes?
It is the question, isn't it? I mean, if I had a magic 8 ball and I could tell you the answer, I absolutely would. But sadly, our podcast budget does not stretch to that. Now, there have certainly been rumours. And I think it's really important to note that we have no evidence at the moment these rumours are coming from the Treasury itself. They seem to be coming from third parties. And obviously, there were a lot of rumours last year too, which caused people to panic, take their tax-free cash when perhaps they didn't need to or didn't have a plan for it. And then actually, we didn't see that policy being announced. And if you do take your tax-free cash in a panic knee-jerk reaction when you don't need it and you don't have a plan for it, that can be really damaging in the long term, because as we've already talked about, pensions are these kind of magical, super efficient wrapper where your money can grow without you having any tax on that growth. And as soon as you take it out of that wrapper, then suddenly that growth becomes taxable because you probably don't have enough ISA allowance to then put that money into your ISAs.
Yeah, look, there's been, we can give some context here. There's been high profile sort of warnings, basically, that, that maybe it might make sense to access tax-free cash ahead of the budget. As you say, we don't know that anything is about to happen.
No.
I think we should absolutely caution against making any decisions sort of in anticipation of tax changes. I actually, for what it's worth, think it's pretty unlikely that we'll get that kind of change. The reason that people are so worked up, we've got a Labour government, it's in need of tax revenue.
Yeah.
We know that. Other areas of the tax system have been kind of like deemed out of bounds in terms of tax rises. So everyone's casting around looking for where they might look to raise money. And you've got sort of significant people in the Treasury who have previously said that, well, yeah, look, we could reduce tax-free cash maybe to a limit of £100,000, say. I think it's quite unlikely. Why? Well, as I've said, it's an absolutely key differentiator for pensions versus other ways of saving.
Absolutely.
You've got to wonder, really, if a lot of people will bother if that advantage is actually reduced.
Yes, and I think it's worth pointing out that even if they did make changes, it's so unlikely that anything would happen overnight. Because if you look at the previous times that the tax-free cash allowance has been reduced, people have been given about a year's notice before any changes have come into effect.
Yeah.
And that's because pensions are a really long-term thing. People spend decades planning their retirements. And if you move the goalposts overnight, that can really derail people's plans. If you look at the inheritance tax changes we've got coming up, where unspent pensions will come into the scope of IHT.
Yeah.
That was announced in last year's budget. It's not coming into force until 2027 because clearly there's an appreciation that when you're doing stuff to pensions, you need to give people notice.
Yeah. And you mentioned before the protections that people have for their tax-free cash. That is because we've had previously much higher lifetime allowances on pensions that have been reduced. And that a function of that is that the tax-free cash allowance is reduced as well. But at those moments, the government has said, well, actually, you can protect that. And it makes it a really messy, complicated system, but it does ensure that, what you can't, I think it would sort of offend basic fairness to say people have contributed to a system under one set of rules with one set of expectations and made long-term plans based on that. And then we're changing it. So suddenly you thought you were going to get 250,000 of tax-free cash. Now you're only getting 100. Yeah. I think, touch wood, we don't know, but that just seems so that will be so controversial.
Yeah.
And another reason why I think it's unlikely to happen, actually, is that any proposed changes to make pensions less generous, be that on tax relief or tax-free cash, anything, the people that hits hardest of all are, or disproportionately, I should say, are people working in the public sector because of the defined benefit pensions that you mentioned before. Now, should that make a difference? Maybe not, but would it? Probably, in terms of who the government is going to pick a fight with and who they're going to upset. So for all those reasons, we don't know, but it would be super controversial, wouldn't it, if they came up with anything dramatic on tax-free cash at the budget?
Absolutely.
Okay, so we have we were going to take a look at some work that you've done actually in the past week or so, writing about this decision to take tax-free cash. We know that some people have moved to do it, perhaps maybe because of rumours, but also actually maybe because of that change to IHT and how pensions are treated with inheritance tax. But you framed an article with the good reasons to take tax-free cash and the bad reasons. So let's start with the good reasons, shall we? Yeah. Well, why might it make sense? Why might it make sense, I should say, to take your tax-free cash now?
So if we put the autumn budget to one side for a moment, this is an incredibly valuable allowance. And if you've budgeted for this money, if it's part of your financial plan, then fantastic, go make the most of the allowance. So one of the most popular reasons that you see for people taking their tax-free cash is because they want to retire early. So you mentioned earlier that at the moment you can access this money from 55. So someone could retire at, say, 57, take their tax-free cash, and that would help to supplement their income until they reach state pension age, if they've calculated that they can do that and retire at that age. Another popular reason is people wanting to clear their mortgage debt. So they've kind of thought, okay, I want to reduce my expenditure in retirement. Let's clear this debt now using the tax-free cash. Another popular reason is gifting to kids. So say your children are getting married or buying a house. Some people want to use the tax-free cash to make that gift. And the earlier you do it, the better your chances are of living another 7 years and, ticking that IHT 7-year rule box. You might also do it if you've got some unused ISA allowance. So as a couple, you might have up to £40,000 ISA allowance. So you might want to take some of the tax-free cash and put 40k into your ISAs. But I think the key message here is basically, have you budgeted for it? Have you planned for it? If so, great, fill your boots. Yeah,
exactly. So it's whether or not you're going to kind of expose it to a kind of tax that wouldn't be exposed to.
Yeah.
Moving it into ISAs obviously doesn't do that because growth was tax-free in a pension and in an ISA. Okay, then, so what about the bad reasons to do this? What might be some rash sort of motivations for people to take tax-free cash?
So we've alluded to it a lot already, but I mean, one of the key ones is having a knee-jerk reaction to speculation, assuming this allowance will disappear and just taking it because you're worried and when you don't have a plan or a reason to do it. That might not be the best idea. Another not great reason that I've heard people citing is that they're worried about market volatility. And so they want to take the tax-free cash and put it in a savings account. Now, this actually just doesn't make sense because you could leave it in that pensions wrapper and simply move it from investments into, say, a money market fund, which is a cash-like investment that's lower risk. And
if indeed that's the right thing to do anyway, because that will depend on your longer term plans, right?
Exactly. It might not be the right thing to do, but if your goal was to move it into cash, then you don't need to move it out of the pension. I guess another one that is a big red flag for me is when people want to game the system by taking their tax-free cash and essentially recycling it by putting it back into pensions to benefit from another round of tax relief. That is a big no-no from HMRC. And if it thinks you've done that intentionally, you could face a tax charge of up to 70%.
Yeah.
And I guess the final one is probably just if you're thinking of making a big unplanned purchase just because that pot of money is there and it's available, thinking maybe I'm just going to go buy a boat. Well, if you've not planned for that boat, maybe that's not the best idea.
Yeah, and you need to think about what the impact on your income later on, because your pension, after all, is there to generate an income for you in retirement, and a quarter of it is a large amount of it. You can spend it for all the good reasons that we've spoken about, but that is going to mean you have less to live on at the end of the day. Okay, we have covered absolutely loads there, so let's leave it there for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or a share. It really does help people find what we're doing here. That all said, Marianna, thanks for joining me.
Thanks, Ed.